For most people, the idea of a bank run is fixed in history. It looks like black and white photograph from the 1930s, long lines of anxious depositors standing outside brick buildings, clutching passbooks, desperate to turn promises into cash. More recently, it looks like television footage from 2008, when customers queued outside Northern Rock branches in the UK, or shaky smartphone videos from regional bank failures years later. In every version of the story, the logic is simple and almost comforting. Ordinary people panic. They rush to withdraw money. Banks collapse because the crowd loses confidence. That image is now deeply misleading. The most dangerous bank runs in the modern financial system do not involve ordinary depositors at all. They do not involve cash machines running dry, police managing crowds, or government officials begging the public to remain calm. In fact, most people never see them happen. By the time the news reaches headlines, the real run has already occurred somewhere else, quietly, invisibly, and among institutions that almost no one outside the financial world ever thinks about. Modern finance does not run on cash. It runs on balance sheets, collateral, short-term promises, and the assumption that tomorrow will look enough like today that those promises can be rolled forward without friction. The vast majority of money that keeps the system functioning never appears as physical currency and never touches retail deposit accounts. It moves overnight between banks, through interbank lending markets, repo transactions, and clearing systems that exist largely outside public awareness. These are the arteries of the system. And when trust breaks there, the damage spreads far faster than any visible queue outside a branch. In the old model, a bank failed because depositors withdrew their money faster than the bank could sell long-term assets. In the modern model, a bank fails because other institutions refuse to lend to it, even for a single night. That refusal is a contemporary equivalent of a run. Instead of people lining up at doors, balance sheets quietly close to one another. Credit limits are reduced. Collateral requirements rise. Overnight loans are not rolled over. Nothing dramatic happens on the surface, but liquidity begins to vanish exactly where the system needs it most. To understand why this matters, it helps to start with a basic but uncomfortable truth. Banks do not primarily fund themselves with customer deposits anymore. Large banks fund themselves in wholesale markets, borrowing from other banks, money market funds, and institutional investors for very short periods of time. Much of this borrowing happens overnight. Every evening, banks with excess cash lend to banks that need it, assuming that the loan will be repaid the next morning. This is not done out of generosity. It is done because everyone believes everyone else will still be solvent tomorrow. That belief is fragile. When confidence weakens, banks do not wait for proof of insolvency. They act preemptively. They stop lending first and ask questions later. From the outside, this looks like nothing at all. From the inside, it is catastrophic. A bank that cannot fund itself overnight does not have days or weeks to adjust. It has hours. If it cannot replace that funding, it is functionally dead, regardless of what its long-term assets are worth on paper. This is why the early stages of the 2008 financial crisis were so confusing to observers. In mid-2007, there were no mass withdrawals by depositors. People were not panicking in the streets. Yet, something was clearly wrong. Interbank lending rates began to rise sharply. Banks started to hoard cash. They became reluctant to lend to one another, even at elevated interest rates. The LIBOR-OIS spread, a technical measure few outside finance had ever heard of, quietly signaled a breakdown of trust between major institutions. What was happening was a silent run. Banks had begun to doubt the value of the assets sitting on other banks' balance sheets, particularly those tied to mortgage-backed securities. But instead of announcing those doubts publicly, they acted through the only channel that mattered. They stopped providing short-term funding. Liquidity dried up not because money disappeared, but because trust did. The visible crisis came later. Lehman Brothers collapsed in September 2008, but the run that killed it had already been underway for months, hidden in funding markets that never make the evening news. This pattern has repeated since then, often without the drama of a full-scale collapse. In September 2019, years after regulators declared the system safer and better capitalized, the U.S. repo market suddenly seized up. Overnight interest rates spiked violently. Banks that were supposed to be flush with reserves refused to lend cash against Treasury collateral, the safest asset in the world. There were no protests, no panic depositors, no breaking news alerts for the general public. But the Federal Reserve stepped in within days, injecting liquidity to prevent the problem from spreading. Again, the issue was not a lack of money in aggregate. It was a lack of willingness to lend it, even temporarily, even against supposedly risk-free collateral. That reluctance is the modern definition of a bank run. It is not emotional. It is not visible. It is entirely rational from the perspective of individual institutions trying to protect themselves in an environment of uncertainty. What makes these silent runs so dangerous is that they attack the system at its most vulnerable point, short-term funding. Long-term assets can survive volatility. Capital ratios can look healthy on quarterly reports. But no financial institution can survive the sudden loss of overnight liquidity. The system is designed to function only as long as participants assume continuity. Once that assumption weakens, even briefly, the machinery grinds to a halt. This creates a paradox at the heart of modern finance. Stability depends not on transparency or resilience, but on the continuous suppression of doubt. As long as institutions believe everyone else believes, the system holds. Once that recursive belief breaks, it collapses inward, quietly and quickly. The public sees the aftermath, not the cause. By the time policymakers speak of confidence, it has already vanished where it mattered most. The uncomfortable implication is that ordinary people are no longer the primary source of financial panic. They are downstream. The first movers in crisis are banks, funds, and central institutions that monitor liquidity conditions minute by minute. They pull back long before retail customers are aware that anything is wrong. By the time depositors are told to remain calm, the silent run has already done its work. Understanding this changes how we should think about financial crises. The question is no longer whether people will panic, but whether institutions will trust one another tomorrow morning. And that trust, once withdrawn, does not return easily. It leaves behind a system that may look calm on the surface, but is increasingly dependent on unseen interventions to keep functioning at all. If part one is about recognizing that modern bank runs happen out of sight, then the next step is understanding where they actually occur. The answer lies in the plumbing of the financial system, the overnight market, the repo market, and the short-term funding mechanisms that allow trillions of dollars to move every single day with almost no public attention. These markets are not side features of finance. They are the core infrastructure. And like plumbing in a building, they are ignored until pressure drops and everything stops working. At its simplest, the overnight market exists because banks rarely end each day perfectly balanced. Some finish with excess cash. Others finish short. Rather than holding large idle buffers, banks lend to one another overnight, expecting repayment the next morning. These loans are usually unsecured, meaning they rely almost entirely on trust. The lender assumes the borrower will still exist tomorrow. The borrower assumes access to this funding will continue. This assumption is not written into law. It is cultural, structural, and fragile. The repo market, short for repurchase agreement, performs a similar function but with collateral. One institution sells a security, often a government bond, to another with an agreement to buy it back the next day at a slightly higher price. Economically, this is a short-term loan. The difference in price is the interest. The collateral is supposed to make the transaction safe. But safety in finance is rarely absolute. It depends on whether the collateral will still be accepted tomorrow and on what terms. These two markets together move enormous volumes. Trillions of dollars are rolled over daily. Most participants do not expect stress. They expect routine. That expectation is the system's hidden dependency. As long as everyone believes funding will be there tomorrow, no one questions the structure. When that belief weakens, the system does not fail gracefully. It seizes. A silent bank run begins not with withdrawals, but with hesitation. Lenders started to ask slightly different questions. Is this counterparty exposed to assets I do not fully understand? Is their balance sheet as strong as it looks? Are others still lending to them? These questions rarely lead to public statements. They lead to internal risk limits being adjusted. A bank may reduce the amount it is willing to lend overnight. A money market fund may demand higher quality collateral. A repo lender may increase the haircut, requiring the borrower to post more assets for the same amount of cash. Each of these actions is rational in isolation. Together, they are destructive. Haircuts are especially important. In calm times, AU.S. Treasury bond might be accepted at nearly full value in a repo transaction. In stress, that same bond might require a larger discount. This forces borrowers to find additional collateral or reduce borrowing. If enough lenders do this simultaneously, liquidity evaporates. The borrower may still be solvent in a long-term sense, but it becomes illiquid immediately. In a system built on rolling short-term funding, illiquidity is often indistinguishable from failure. This is how a modern bank run progresses. No one announces panic. No one withdraws cash. But funding becomes more expensive, more conditional, and eventually unavailable. The system does not collapse because assets suddenly lose value, but because they cannot be financed overnight. The market is not voting on solvency. It is withdrawing trust. The events leading up to the 2008 crisis illustrate this clearly. In 2007, mortgage-backed securities were still widely rated as safe. Banks continued to report strong capital positions. Yet interbank lending began to freeze. Institutions became unwilling to lend unsecured funds, even for one night. Repo lenders began to scrutinize collateral tied to housing. What followed was not a visible run, but a gradual choking of liquidity. By the time Lehman Brothers failed, it was already effectively shut out of the short-term funding markets that kept it alive. The lesson should have been clear. Instead, it was partially forgotten. In September 2019, the U.S. repo market experienced a sudden shock. Overnight repo rates spiked dramatically, at times reaching multiples of the Federal Reserve's target rate. This was puzzling. Banks were holding large reserve balances. Treasury securities were abundant. There was no obvious crisis. Yet lenders refused to provide cash at normal rates. Something in the system had tightened. The explanation, in hindsight, was structural fragility. Regulatory changes had made banks more cautious about deploying balance sheet capacity. Cash was concentrated in institutions unwilling or unable to lend it freely. When demand for funding rose slightly, the system lacked elasticity. Trust did not vanish completely, but it thinned just enough to cause dysfunction. The Federal Reserve intervened, injecting liquidity to stabilize rates. Without that intervention, the disruption could have cascaded. What matters is not that the Fed acted, but why it had to. The repo market failed to clear on its own. Institutions did not trust that lending overnight would be riskless, even against Treasury collateral. The market signaled stress long before any visible crisis emerged. For most people, nothing happened. For the financial system, it was a warning. These markets are often described as technical, but their behavior reflects human judgment under uncertainty. Models assume liquidity. Regulations assume orderly markets. But trust cannot be regulated into existence. When participants fear being the last lender standing, they retreat. This retreat does not look like panic. It looks like prudence. And that is what makes it so dangerous. Another misconception is that central bank reserves eliminate the risk of funding stress. Reserves are unevenly distributed. They sit on specific balance sheets and are constrained by internal rules and incentives. A bank may have reserves and still refuse to lend them if doing so increases perceived risk. Liquidity is not just about quantity. It is about willingness. Silent bank runs exploit this distinction. They operate in the gap between theoretical abundance and practical reluctance. Money exists, but it does not move. Collateral exists, but it is no longer sufficient. The system's gears slip, even though all the parts appear intact. From the outside, this fragility is invisible. Markets may look calm. Asset prices may not move dramatically. There are no crowds, no sirens, no emergency speeches. But inside the system, the signals are unmistakable. Spreads widen. Volumes drop. Overnight funding becomes elective. The quiet withdrawal of trust does the work that panic once did publicly. By the time policymakers acknowledge a problem, the run has already occurred where it matters most. The visible crisis, if it comes, is a secondary event. The real rupture happens first, in markets most people never see, driven not by fear in the streets, but by caution in spreadsheets. By the time stress reaches overnight and repo markets, the problem has already moved beyond individual banks. What happens next determines whether a disruption stays contained or becomes global. This is where central banks enter the picture, not as neutral referees, but as participants in a deeper and more revealing loss of trust. Silent bank runs do not stop at private institutions. At their most dangerous stage, they reflect central banks quietly losing confidence in the marketability and, in some cases, in each other to keep the system functioning. To see this, it is necessary to understand the role of global currencies, especially the U.S. dollar. The modern financial system is built on dollar funding. Banks outside the United States borrow and lend in dollars every day to finance trade, service debt, and hedge exposures. European banks, Japanese banks, and emerging market institutions all rely on access to dollar liquidity, often obtained through private markets, such as FX swaps and cross-currency funding. Under normal conditions, this works smoothly. Under stress, it does not. When private markets function, central banks stay in the background. When they stop functioning, central banks replace them. This substitution is not subtle. It takes the form of swap lines agreements between central banks to exchange currencies, typically local currency for U.S. dollars, with a promise to reverse the transaction later. Officially, swap lines exist to provide liquidity. Unofficially, they exist because trust in private funding markets has failed. The key point is this: central banks do not activate swap lines because banks have run out of money. They activate them because markets have stopped trusting one another to distribute that money. Swap lines are not a sign of abundance. They are a signal of breakdown. This became unmistakable during the 2008 financial crisis. As U.S. mortgage losses spread globally, dollar funding markets froze. Non-U.S. banks could not obtain dollars through normal channels. FX swap markets, which usually allow banks to convert local currency funding into dollars, became dysfunctional. Spreads widened dramatically. The cost of dollar funding surged, even for institutions that appeared solvent. The problem was not creditworthiness alone. It was fear of exposure in a system whose risks were no longer clearly understood. In response, the Federal Reserve opened massive dollar swap lines with the European Central Bank, the Bank of Japan, the Bank of England, and others. At their peak, these swap lines reached hundreds of billions of dollars. This was unprecedented. The Fed was effectively acting as a global lender of last resort, not just for U.S. banks, but for the entire dollar-based financial system. This action stabilized markets, but also revealed something uncomfortable. The global system did not trust itself to function without direct coordination among a handful of central banks. Private interbank markets had failed. The price mechanism had failed. Confidence had to be replaced administratively. The same pattern repeated in March 2020. When the COVID-19 shock hit, financial markets seized before the real economy shut down. Treasury markets became illiquid. FX funding markets showed extreme stress. Dollar shortages appeared globally within days. Once again, the Federal Reserve reopened and expanded swap lines almost immediately. The speed mattered. Central banks were not reacting to bank failures. They were reacting to the early stages of a silent run across borders. What is often overlooked is what swap lines imply about trust between central banks themselves. These arrangements are not automatic. They are discretionary. The Fed chooses which central banks receive access and which do not. This creates a hierarchy in the global system. Some countries are implicitly trusted backstops. Others are not. During stress, this hierarchy becomes visible, and that visibility can itself generate instability. For central banks without swap lines, the message is clear in a crisis. You are on your own. This encourages self-insurance through reserve accumulation, capital controls, and defensive policies that fragment the global system. Trust does not vanish all at once. It fractures along political and institutional lines. Even among central banks with established relationships, swap lines are not a sign of mutual confidence. They are a sign of mutual concern. They exist because each central bank doubts that private markets will reliably transmit liquidity under stress. In other words, central banks are stepping in not because they distrust each other's solvency, but because they distrust the system connecting them. This distinction matters. The silent run at this level is not about one institution failing. It is about the market mechanism itself being suspended. When central banks replace markets, price signals lose meaning. Liquidity is allocated by policy decision rather than risk assessment. This may prevent collapse, but it also deepens dependence on coordination that cannot be taken for granted indefinitely. There's another layer to this loss of trust. Central banks rely on each other's balance sheets, policies, and political stability. When geopolitical tensions rise, financial trust becomes harder to separate from strategic considerations. Access to liquidity can be weaponized or perceived as conditional. The freezing of foreign exchange reserves and the use of financial sanctions in recent years have reinforced this perception. Even if central banks publicly deny politicization, the incentive to reduce exposure grows quietly. This creates a feedback loop. As trust in cross-border liquidity weakens, institutions seek safety in domestic assets. Markets become more segmented. The need for central bank intervention increases. Each intervention confirms that markets cannot be relied upon in stress. Over time, the silent run becomes a structural feature rather than an episodic event. Crucially, none of this requires public panic. No depositors need to withdraw funds. No bank needs to fail visibly. The system can remain outwardly calm while its internal reliance on emergency backstops grows. Stability becomes conditional on coordination, speed, and political alignment among a small number of actors. The result is a financial system that appears robust but is increasingly brittle. It does not fail often, but when it does, it fails everywhere at once unless arrested immediately. Central banks are aware of this. That is why they move faster and more forcefully than ever before. The silent bank run they fear is not one they can see on the streets. It is the one they monitor through funding spreads, swap usage, and market depth indicators that never appear on the news. By the time swap lines are activated, the loss of trust is already real. The only question left is whether coordination can restore it before fragmentation becomes permanent. By the time a silent bank run reaches a level of central bank coordination, the system has already crossed a critical threshold. What remains is not a question of whether something is broken, but how much of the break can be concealed, managed, or postponed. This final stage is rarely described as a crisis, because admitting crisis would undermine the very confidence the system now depends on. Instead, it is framed as market functioning, liquidity support, or temporary measures. The language is careful because the system cannot afford honesty. At this point, the defining feature of modern finance becomes impossible to ignore. It is a system that cannot openly acknowledge panic. Traditional bank runs were visible and therefore stoppable through reassurance guarantees or closures. Silent runs operate in the opposite direction. They are invisible to the public, but fully visible to policymakers, who must act without signaling fear. The challenge is not merely technical. It is psychological and political. Every intervention designed to stabilize funding markets carries an implicit admission that markets cannot stabilize themselves. Central banks insist these actions are preventative, not reactive, but prevention on this scale reveals the underlying fragility. When overnight markets, repo markets, and global funding channels require continuous backstopping, the distinction between normal operations and emergency measures erodes. What was once exceptional becomes routine. This creates a dangerous illusion of resilience. Because collapses are avoided, the system appears strong. But strength is increasingly measured by the speed and size of intervention, not by the ability to function without it. The absence of visible failure masks the accumulation of dependency. Markets learn that liquidity will arrive when needed. Institutions adjust behavior accordingly. Leverage remains high. Maturity mismatches persist. Trust is no longer organic. It is manufactured. The end game of this process is not necessarily a dramatic crash. It is a system that survives by narrowing the range of acceptable outcomes. Volatility is suppressed. Price discovery weakens. Risk migrates rather than disappears. Silent runs become less frequent not because trust has been restored, but because distrust has been absorbed into permanent support structures. The system adapts to fragility by institutionalizing it. For the public, this evolution is almost impossible to see. Deposits feel safe. Payments clear. Markets recover quickly from shocks. Each successful intervention reinforces a belief that authorities are in control. But control is conditional. It relies on coordination, credibility, and political alignment that cannot be guaranteed indefinitely. The system functions not because risk is low, but because it is continuously deferred. The most unsettling aspect of silent bank runs is that they invert responsibility. In classic narratives, the public panics and authorities respond. In the modern system, institutions retreat first, and authorities respond before the public notices anything at all. Ordinary people are not the source of instability. They are shielded from it until shielding becomes too costly or too politically difficult to maintain. This raises an uncomfortable question. If trust is withdrawn at the top, what happens when the mechanisms designed to hide that withdrawal begin to fail? Central banks can supply liquidity, but they cannot force trust between private actors indefinitely. Swap lines can bridge dollar shortages, but they cannot erase geopolitical fractures. Regulatory buffers can slow crises, but they cannot eliminate the incentives to run when uncertainty rises. At some point, the system's reliance on silence becomes a vulnerability. The longer panic is suppressed, the more violent its reemergence may be. This does not mean collapse is inevitable. It means that stability has become contingent rather than structural. It exists because certain actors continue to act, not because the system can stand on its own. In this sense, silent bank runs are not anomalies. They are signals. They reveal where the system is weakest, in its dependence on short-term trust, in its reliance on a few central institutions, and in its need to maintain confidence without transparency. The fact that these runs are unseen does not make them less real. It makes them harder to confront. The modern financial system presents itself as calm, rational, and managed. Beneath that surface, it is constantly negotiating its own survival, night after night, through markets most people will never hear about. The absence of visible panic is not proof of safety. It is evidence of how much effort is required to keep panic out of sight. In the end, the most important bank runs are no longer those that empty vaults. They are the ones that drain belief. And belief, once quietly withdrawn at the highest levels of the system, is far harder to restore than cash.